Will we see mortgage interest rates as high as Snoop Dogg by the end of the year? Is there a recession around the corner? And why did Zillow just admit that they totally missed home value predictions for 2022? Also, why is the Federal Reserve trying to put out the economic forest fire with gasoline? And should I order steak or pork tacos for dinner? Answers to all of these questions and more as we kick off this edition of Taco Tuesday. Hello and welcome to this edition of Taco Tuesday and Ask the Lender. As you know, today is my favorite day of the week. Don't forget to treat yourself, your family, your coworkers, and friends to the deliciousness of tacos. And make sure to stick around towards the end where I revealed Zillow's big mistake that may see home prices increase more than they did last year. Next, do me a favor and subscribe to my channel. Click that bell right there to get notified when I post more helpful content just like this. The flames of inflation are roaring to the highest level in 40 years. The Federal Reserve seems more concerned about making Wall Street happy instead of reducing the 7% inflation we are currently experiencing. And to make matters worse, it is expected that that figure could be 7.5% in Thursday's Consumer Price Index report. At this rate, my tacos will soon consist of a tortilla, lettuce, and maybe a little bit of hot sauce. I may have to take it from Taco Bell. But we already know that the Fed wants to hike rates and reduce their $9 trillion in mortgage-backed securities, but they keep buying mortgage bonds and treasuries. Why? They have already announced they are tapering or slowing down their buying and should be done with their purchases in March. But if they plan to reduce the balance sheet this year, why continue to buy more? The federal funds rate is already at 0%, but when you factor in inflation that is standing at 7%, that gives us a negative 7%. So the last few times we've seen the Fed funds rate this far negative, we experienced a recession. Additionally, every time the Fed has had to aggressively fight inflation, we went into a recession. In 1982, the last time inflation was this high, the 30-year fixed rate was 16.04%. Now, interest rates for the popular 30-year fixed mortgage now stand at an average of 3.75%. So there is some good news, as even if rates increase to maybe 4% or a little higher, we are not at those record levels that we were back then. I remember my mom and stepfather financing their first home for 18% interest. And also, we're better off paying a slightly higher mortgage rate than that 7% increase that we have in inflation on everything that we buy in life. Inflation has impacted the price of absolutely everything that we buy. So the Fed raising rates is a good thing for the economy, as that will bring inflation down. So if you have to pay a couple of $100s a month more for a mortgage to bring your overall cost of living down, so be it. Now, unless everything goes to crap, it is unlikely that we will see rates in the 5s or even 6s this year. There are other concerns, and the warning signs are clear. According to the National Association of Realtors, wholesale sales were down 3.8% between November and December of 2021. And according to Realtor.com, inventories have slumped 28% from this time a year ago. So combine that with home prices at record highs, and you can understand why home buyers, particularly first-timers, may be tearing their hair out. Home buyers got crushed last year as home prices soared at their highest clip on record. Housing economists saw that price growth, which peaked at a year-over-year rate of 20% last year. They said that was unsustainable. Their economic models agreed, and among the 7 forecast models reviewed by Fortune magazine the beginning of this year, every single one predicted home price growth would slow down significantly. But over the past few weeks, that consensus is no longer unified. And now more industry insiders are throwing out their previous forecast and replacing them with more bullish short-term outlooks. Some experts say that the 2022 spring housing market might go down as one of the most competitive on record. Back in December, Zillow predicted that U.S. home values would climb 11% this year in 2022. Economists at Zillow now say that forecast is way too conservative. Their latest forecast finds home prices are set to spike 16.4% between December of 21 and December of 2022. If that happens, it would mark another brutal year for home shoppers. Now, why is Zillow all of a sudden raising its 2022 home price growth forecast? Well, let's face it, a lot of it boils down to inventory. During the pandemic, inventory plunged to a 4-decade low as more buyers rushed into the market. That trend was predicted to reverse late last year as forbearance protection programs lapsed and mortgage rates rose. But not only has that not happened, the inventory situation has gotten worse. In January, there were just over 923,000 U.S. homes listed for sale on Zillow, so that's down 40.5% from the pre-pandemic level in January of 2020 and down 19.5% from January of 2021. But there is a big wild card. As the Federal Reserve shifts policy to help tame inflation, its moves will indirectly result in higher mortgage rates. In fact, the average 30-year fixed mortgage rate in January already spiked to 3.56%, and that's up from 3.11% in December. That marks the biggest one-month jump in mortgage rates in more than 9 years. Home buyers and sellers alike would be wise to take Zillow's 16.4% price growth prediction or any other real estate forecast model with a grain of salt. After all, none of the major real estate forecast models predicted the historic home price boom we've seen over the past 2 years. When the pandemic struck in the spring of 2020, Zillow and CoreLogic both predicted home prices would fall by the spring of 2021. So if you or someone you know are looking to purchase or refinance a home, make sure to connect with me. And don't forget, help me out. Subscribe to my channel and click that bell right there to get notified when I share more helpful content just like this.